BlackRock is the biggest asset manager in the world with assets under management north of $14 trillion. Every quarter, asset managers are releasing 13F, and we have a chance to see what they were buying and selling. I went through the latest 13F of BlackRock, and in this video I will present for you 5 stocks BlackRock was mostly buying in the latest quarter. It's very important for retail investors to know what smart money was buying and selling. So watch this video until the end and let me know, do you agree with the picks? Also let me know if you have any of these companies in your portfolio. The first company is Google, ticker symbol GOOGL. This is the largest percentage change for the BlackRock's portfolio. Currently, Google is taking 2.33% of BlackRock's portfolio, and in the latest quarter, they accumulated 441.99 million shares of Google. Google is absolutely beast of a company, dominating search and advertising market. Most of the money is coming from search, $63 billion. The cloud revenue, $17 billion in the latest quarter. Google subscriptions, $13 billion. YouTube ads, $11 billion. Google network segment is declining and currently taking $7.83 billion. Snapshot of the latest quarter of Google, 17% year-over-year growth in search, absolutely mind-blowing after everyone already said that search is dying. Gemini up monthly active users 750 million plus. YouTube revenue 60 plus billion from YouTube ads and subs in 2025. Google Cloud made 70 plus billion dollars annualized revenue run rate. In Q4, the revenue growth was north of 48% year-over-year. Gemini API usage is as good as never before, 10 billion plus tokens per minute and 325 million plus paid consumer subscriptions for Google. Meanwhile, financial Twitter is dominated by tweets from Anthropic and users of Anthropic and Claude. Every day you're waking up and there is something new, some new innovations from Anthropic. And let me remind you that Google actually owns part of Anthropic. Based on different data, they own different percentage, but approximately their ownership of Anthropic is 12 to 14% of Anthropic. At last round, they was valued at 350 billion, and I believe now they should be valued much more because Anthropic is totally dominating enterprise segment. Google Cloud reaccelerated and now is growing fastest comparing to other major competitors of cloud. Here you can see AWS versus Azure and Google Cloud. The Google Cloud is a blue line, and as you can see in the latest quarter they grew 48%, meanwhile Microsoft Azure 39%, and Amazon AWS reaccelerated to 24%. Here I need to say that the largest cloud computing companies are Amazon and Microsoft. Their base is much larger, so it's more easy to grow from smaller base, and the Google Cloud is the smallest. But we can see on the chart that there was a time when Microsoft was growing faster than Google. So now this inflection point in the latest quarter where Google reaccelerated and Microsoft decelerated is showing that Google is doing everything right and they are taking market share. And you can see the proof of taking market share. Here you can see the generative AI traffic share. 12 months ago, Gemini is this red segment is almost not existed in the chart, and now you can see they grew to quite significant amount. So they are taking aggressively market share from ChatGPT and other competitors, mostly from ChatGPT. Google is absolutely beast of a company. Here you can see shareholder return for Google. The free cash flow is stable even though it's damaged significantly by high capex, but still we can see quarterly Google is still making $25 billion in free cash flow. But they started to buy back significantly less amount of shares, and the reason for that is that they see a very large opportunity in AI and they want to build as many capacity as possible. That's why you can see in March 2025 it was regularly around 17 billion in stock buybacks. Meanwhile, June 13 billion, then September 12 billion, and now in December 2025 only $5 billion in buyback. This could be also because Google valuation now is significantly higher. The price to earnings extended because the share price increased significantly. But still, I believe that main reason they want to save money on buyback to reinvest more into the business. Meanwhile, Google started to pay dividend and now they are paying $2.5 billion per quarter in dividends. As I just mentioned, Google valuation increased quite significantly. So here you can see in April 2025, on April's liberation date, Google PE was around 17, and then it ran all the way to 30, more than 30, even 31. And now we have another kind of correction because the macro instability, and also we have a war in Middle East, and also the oil price is increasing. So now the situation in the market is very unpredictable, and every company is correcting. Google is not exception. Google PE now is 25.38. I would say this is the medium. Actually, this is the cheaper than a medium. Medium is 27.92 from the perspective of price to operating cash flow, because we should not value Google now on price to free cash flow ratio, is because they are reinvesting a lot of money to the capex. That's why price to operating cash flow is much more a valuable metric for Google valuation as for today. And in the last 10 years, the medium is 18.26. Meanwhile, we're trading currently at 20. So I believe 10 to 15% down more for Google will be average valuation for Google, and will be more interesting prices to buy for the long term if you don't have position today. The second company on the list is also Google. So actually they were betting quite big on Google. The third company is Eli Lilly. They bought 66.79 million shares, and now Eli Lilly is taking 1.1% of BlackRock's portfolio. Eli Lilly is Pharmaceutical Giant, and they have north of 150 years of history. The company is very profitable. They're making $6.64 billion in net income. The revenue, net income, free cash flow, all growing. Margins are quite high. Gross margin reaching north of 80%. Operating income, free cash flow margin also quite high. Mostly free cash flow positive. In 2025, they printed $9 billion in free cash flow. But here, needed to say that they almost returned almost 100% of free cash flow to shareholders via share buybacks and dividends. You can see $9 billion in free cash flow. Meanwhile, stock buybacks 4.11, and here another 5. So more than $9 billion the return to shareholders. This is expected because this is a pharmaceutical giant, but still I would hope that they will keep more money to reinvest back into the business. Their debt is quite high, with total debt reaching $44 billion, and total cash and cash equivalents is only $7.27 billion. The problem I have with pharmaceutical companies is because it's difficult to predict their revenue growth. Here you can see the revenue growth for Eli Lilly from 2012 to 2025. In 2014, they developed Trulicity from diabetes, Verzenio for breast cancer in 2017, then Mounjaro for type 2 diabetes in 2022, and then we can see quite significant growth after this particular drug. And then we have a blockbuster Zepbound for weight loss, and after that in 2023 the revenue just exploded and doubled in 2 years. So the conclusion from here is that if you are not pharmaceutical professional, it's really difficult for retail investors to invest successfully in the pharmaceutical companies. Yes, they are paying the dividends. Yes, they are really friendly to shareholders. But the problem of predictability for pharmaceutical company, if you're not a professional, is really a problem for me. Meanwhile, we are moving to the next company, and this is memory giant Micron Technology. They bought 100 million shares, and now Micron is taking half of the percent of BlackRock's portfolio. The most important thing you need to understand about Micron is that this is a cyclical company, and here you can see visualized Micron Technology operating income over time. You can see we have a boom and then bust, and then boom and then bust, and now we are going to boom again. So the question investors are asking right now is this the top for Micron? Currently AI need a lot of memory. And there was a news recently that Google introduced TurboQuant algorithm. This is the new compression algorithm that reduces LLM key value cache memory by at least 6x and delivers up to 8x speed up. After that, all memory companies were down 8 to 10% on the day. My personal opinion that this is not bearish for memory companies. It could damage some pricing power of memory producers, because I believe the more software improvement we are making, the faster we are innovating. So I believe we are just beginning with this AI super cycle. Full disclosure, I am not invested in Micron. I believe that I do not have enough expertise to understand the cycle, but from the AI perspective, I feel that we are definitely not in the top of the AI cycle. The fifth company is Apple. BlackRock bought 1,154,000,000 shares of Apple, and now Apple is taking 5.3% of BlackRock's portfolio. I can tell you that I was not understanding Apple for quite a long time. The reason is because their revenue was not growing for a long time. They are buying back and paying in dividends 100% of their free cash flow. But I think that now I actually understand why whole Wall Street and all smart money are so bullish on Apple. Let me explain and share with you as well. So currently Apple makes most of its money from iPhone, $85 billion. Then we have high margin services, $30 billion. Then we have home accessory, iPad, $8 billion, and Mac, $8 billion. Now let me tell you that most of the AI operations currently is happening in the cloud. Every time you are making prompt to ChatGPT or Claude, this request will be sent to the cloud, then processed in the cloud, and then it will come back to your local computer. I can 100% assure you that security and privacy will be very important in post-AI era. In this case, Apple is very well positioned to win this AI revolution because they have very high quality chip in iPhone, so you can run your offline AI model directly on the iPhone. And then they have very powerful MacBooks and iPads as well. So if Apple continue to innovate with their custom silicon, they can run offline LLM directly on device without sending this data to the cloud. This is very, very important to understand, and I believe this will lead to another Apple supercycle. I don't really like how Apple is managing their money. $98 billion in free cash flow. Meanwhile, they are buying back $90 billion in stock buybacks and also paying dividends of $15 billion. I believe that in the AI revolution, they'd better spend more money on research and development. And the valuation for Apple is also not cheap at all. For the last 10 years, we see the median is 25. Now Apple is still trading at 31. And the main reason is because Wall Street is not punishing them because they do not have huge capex. Thank you so much for watching. If you are interested in a platform used in the video, it's InvestKit. I will link the link in the description below. We are doing beta test and all the premium features are free. So feel free to come and give it a try. Thank you so much for watching and I'll see you in the next one.